If you are one looking to build a diversified investment portfolio, or just looking for an opportunity to earn an income with your investments, if you watch this video until the end, you will be shocked at how well a dividend fund like SCHD could do for you rather than bond funds. Which, before getting started, understand that I am not talking about fixed income securities such as US Treasuries or CDs. I'm strictly mentioning bond funds within an investment portfolio. So to get straight to it, here is a quick breakdown explaining what is SCHD. For those that don't know, SCHD is a dividend ETF that Charles Schwab offers to investors, where the fund tracks the Dow Jones US Dividend 100 Index. All that means is if you put your money into SCHD, that you are investing into 100 of the strongest dividend paying companies in the US. And in order for those companies to be listed inside of this fund, they have to meet specific criteria, where each stock must have sustained at least 10 consecutive years of dividend payments, have a float adjusted market cap of 500 million, where they also have to meet minimum liquidity criteria. Not only do they have to meet those requirements, but after that, each company is evaluated based on 4 fundamental characteristics, that is, their cash flow to debt, return on equity, dividend yield, and 5-year dividend growth rate. So if you've ever heard of Chevron, Home Depot, Verizon, UPS, Lockheed Martin, Pepsi, Pfizer, Coca-Cola, the list of strong dividend paying companies you've probably heard of are all inside of this fund and just continues to go on and on. On top of that, the Dividend 100 Index has even more criteria it must fill in order for the companies to join or stay within the fund, but a key one to know is that stocks in the index are weighted quarterly based on a capped float adjusted market cap weighted approach, where no single stock can represent more than 4% weight in the index, and no sector can represent more than 25% at the time of updating the index. Currently, some of the stocks are above 4%, so this should change the next time they update, but it's nowhere near the risk of a more volatile investment like VanEck semiconductor ETF that has Nvidia with over 23% weight in the fund. And then for sectors in SCHD, you can see financials is currently the largest one at roughly 18%, where many of your investments currently are probably going to be heavily weighted toward the large cap tech stocks. In fact, the unique thing I like about SCHD is that it only has a 7% overlap with the S&P 500, so the way that SCHD is structured makes it extremely appealing for income and growth, but more on that later. And if you are curious, to get exposure to all of this, it only costs a 0.06% fee per year, which is also known as the expense ratio, and is automatically going to be taken out of the fund over time. It's not something you have to pay separately. If you want to check out this page, I'll have a direct link in the description below for you, which all I ask is that if you are finding value in this content, that you consider subscribing with notifications on for future content like this. Moving on from there, here is a quick breakdown explaining the next section: what are bond funds? Now, many of you have probably heard of bonds, which are typically referred to as fixed income securities, where you can get a guaranteed income over a specific period of time. But the interesting thing here that many believe, including myself at one point, is that including a bond fund into your investment portfolio is extremely important. Which, don't get me wrong, there are pros, such as the diversification to many different bonds all within one purchase, away from stock market volatility, where they may get slightly better yields, and have professional managers with knowledge of industry trends and credit analysis to navigate them successfully. But some of the downsides include that if you are getting actively managed bond funds, they will have a management fee, they will fluctuate with the market, and have tax consequences. So if you find a particular bond fund that fits your position, that is great, but from an overall perspective, if you are looking to build an investment portfolio for a long time, or with funds that you don't need to touch in the short term, bond funds will do nothing but reduce the amount of money that you could actually be making over time. Which, near the end of the video, I'll explain why this is so important, whether you're young or at or near retirement. Now, if you didn't know, bond funds can be either an ETF or mutual fund, where a generic example would be Vanguard's Total Bond Market ETF with the ticker BND, that currently has 11,336 bonds, where the fund is categorized under the intermediate term bonds, as the average bond in the portfolio has 8.4 years until it matures. Looking at the fund even further, the distribution by credit quality is from the US government at 68%, then BBB and A following, which shows the level of risk along with the bonds they select. The bonds in the fund are extremely diversified, and just so you know, they pay out the interest on a monthly basis, where a majority of fixed income securities actually pay them semi-annually, which is every 6 months. So that's the general idea of bond funds. Here is a deep comparison on why I'd choose SCHD over bond funds. First off, if you are someone at or near retirement, you may also want to diversify with bond funds just because of the additional exposure away from the stock market volatility. But truthfully, truthfully, I personally believe all around that if you are trying to get away from the stock market's volatility, that fixed income securities such as treasury bills, notes, bonds, tips, I-bonds, CDs, fixed income securities like these, where you can get a guaranteed income over a specific period of time, would be the better approach to take. And then for your investments that you can ride through market fluctuations for at least 10 years without the need to actually sell the investments, strong dividend funds could provide an income that you could use, and you can also have the potential for growth along your investment. Which, if you didn't know, within the markets, dividend paying stocks on average at least tend to be less volatile than non-dividend paying stocks. In fact, SCHD statistically has less risk than the S&P 500, as the beta and standard deviation are lower. And even though SCHD will experience daily fluctuations in the market, over the past 10 years, the worst year's performance was down only 5.5% as a whole for SCHD, where the S&P 500 VOO was down 18%. Now, I'm not saying any of this data is guaranteed in the future, but some of the biggest reasons why SCHD is such a powerful investment is because over the past 12 months, it has paid a 3.45% income to its shareholders, where their dividends have consistently increased every year over the past 12 years. And from just the past 5 years alone, the dividends they pay have grown 12% per year. And just so you know, SCHD pays dividends quarterly. Not just that, but the income you can earn here could be qualified dividends, which means they could be taxed in the long-term capital gains bracket of 0, 15, and 20%, where the income through bond funds are typically taxed as ordinary income unless you purchase specific ones like treasury bond funds that may be exempt from state and local taxes. And the biggest reason to top it all off is that SCHD has achieved an annual return of 11.5% per year over the past 10 years, which that includes the dividends being reinvested back into the fund. But even if you took the dividends as income, an 8% growth rate every year for 10 years is amazing. So here's two generic examples to keep things simple for those that are young and those near retirement on how a strong dividend fund like SCHD could suit you much better than a regular bond fund in an investment portfolio that you know you don't need to sell in the next couple of years. Knowing that, we're going to assume that you have all your money that you need safely stored in fixed income securities so that you can have that guaranteed income without the chance of losing any value on your money. So to start it off, if you are young, you may want to limit the amount of investments that you have toward defensive dividend stock, because if you have all these years ahead of you, you want to take advantage of compounding growth along your investments. So let's just say right now you have all your money in growth, but you want to start adding some defensive stock to reduce volatility and also earn a potential income one day along your investments. So knowing this, let's say you start contributing $300 per month into SCHD. You'd still want to prioritize your growth, so even here you want to reinvest the dividends, but after doing this for 30 years, your defensive portfolio would be at $829,000. But what's crazy is that if you did $300 per month into a bond fund, thinking that it's the optimal way to diversify your portfolio, if you were to do this with Vanguard's BND, that has only averaged a 1.5% annual return over the past 10 years, which includes the income you earn being reinvested back into the fund, which is actually terrible for long-term investors who can ride through market volatility. But looking at the numbers, if you did BND instead, that means after 30 years, your defensive portfolio would be at $136,000. That's a $700,000 difference. I really want to emphasize this for those that are young, because for a while I had a bond ETF in my Roth IRA thinking that I was optimally diversifying my portfolio. But I knew I wasn't touching the funds for a long time, and after looking back at my portfolio after nearly 2 years, BND was barely up, and then my growth fund was up nearly 50%. It wasn't a huge amount I had in BND, but the effect of doing this over time, the difference can be massive. Which I will say, for those on the younger end watching this, I highly recommend you check out my Roth IRA investing video that is extremely important for your future and to build a tax-free dividend income to live off of one day. But from there, it definitely gets interesting once you are at or near retirement, because you really want to focus on the fixed income for security along your hard-earned money. Now, I can't say exactly how much to allocate toward fixed income securities or dividend stocks because there's way too many variables for a generic example, but having a combination of both is extremely important. But I will say, no matter the position, having a strong dividend fund like SCHD within a taxable account is extremely valuable, and if you're in a tax-advantaged account like the Roth IRA, income-producing funds like JPI and JPQ could also be beneficial. So let's say you're near retirement, you have all your fixed income securities set up, and now you have $400,000 that you want in safe income-producing investments. investments. You don't need the money short term, but you want the opportunity to earn some sort of income and growth as well. To keep things simple, let's say that you solely choose SCHD. The first year you would have produced $11,000 in dividend income, which don't forget that these can be qualified dividends, so even in a taxable account, depending on your tax rates, you may be able to avoid the taxes entirely. So let's say you enjoy this income, you're doing some sort of work, you have fixed income securities all set up. If you can do this for 10 years without selling your actual investment, your SCHD would continue to grow and your income in the 10th year alone would be close to $27,000. The most important part about all of this is that your $400,000 investment would now be worth $850,000, which is extremely important at this stage in your life. Now understand that SCHD has done extremely well over the past 10 years, so these numbers may be skewed, but if you just wanted to be safe with a bond fund and you heard Vanguard's BND was the way to go, historically you would have achieved a lower income that statistically wouldn't even have grown over time. It would also be taxed as ordinary income, and after doing this for 10 years, your end portfolio would be at roughly $350,000 instead of $850,000. That's a $500,000 difference with your unused cash by understanding the optimal ways to handle your finances. Which understand, I'm not saying to do this, it's a simple example and I'm not a financial advisor. I just like to find better and better ways to handle investments, which is a huge concept that I talk about on this channel. So if you are interested in this and you find value, consider subscribing with notifications on for future content like this. Which, while I mention it, if you are interested to start investing on a new platform or to check out some of the top CDs in the market, I'll have links in the description below for you. Which, if you find an option that suits you well, I may earn a commission for it, which is greatly appreciated. But because you've stayed this long into the video, I think you may find great value from some of my free learning guides I created, whether that be investing for beginners or my ultimate index fund cheat sheet that includes a ton of data comparing the best index funds I've analyzed. I highly recommend you check that out, which if you want to see how I allocate each of my investments and other exclusive content, consider checking out the Patreon I have linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.